that climate risk will definitely have some financial risk, and it's not just in the developed world, even in the emerging markets. So the regulators actually have started thinking about it, and they agree. They have this consensus that financial risk will be quite significant in the future because of changes in the climate. However, it's very difficult to actually assess it. Actually, we do not yet have good amount of data, proper data to assess. There is hardly any academic work on climate risk, and the impact of climate change on financials will be direct as well as indirect. Now, direct impact is somewhat easy to calculate, but the indirect impact, the non-linear impact, will be very difficult to assess. Hence, it's a challenge for most banks. Now, the climate risk will not only have an impact on individual banks, it will also have impact on the financial system and also the real economy through the financial system, by the way. So how is it going to happen? You have this adverse climate change, because of which there will be impact on profits for some of the firms. For example, firms in the agricultural sector, in the food sector, in the oil and gas industry, and banks who have lent money to these companies will have losses, will have more losses. So there will be increased losses for these banks. What will happen because of that is banks will start reducing the lending to all kinds of industry, not just the companies impacted by climate change, but all kinds of industry, because they're having higher losses. So capital will go up, provision will go up, and so on and so forth. It will have an impact on the lending, how much banks will lend, and because of that it will have an impact on the real economy. Okay, so climate change will not only have an impact on individual bank but also on the financial system, and through financial system it will have a systemic risk on the real economy. And which banks will get affected the most? Well, almost all banks will get impacted because of the changes happening around us, the climate change. Some banks will obviously get more impacted more than the others. Some banks are specialized in areas such as agricultural bank, food and agri banks, or banks involved in oil and gas industry. Those banks will get impacted. Many financial service companies such as auto lending company also will get impacted because of that. But initial study shows that the climate risk will have a significant impact on all banks, regardless of the geography, regardless of the area in which the bank is operating in. This will pose some risk, right? And what we've seen is that climate risk also poses significant tail risk. That means, so what is tail risk? That means a single event could have a huge amount of loss for the bank. And we have also seen that in some countries. For example, the fire in Australia, it had an impact on the agricultural sector, or the drought in the US, or floods in some parts of the Europe. We've seen that many banks losing lots of money because of those incidents, or even it could be like some in some African country we also had earthquakes, right? So because of that also a lot of the banks lost a lot of money. So a single event could cause a significant tail risk. That means banks could lose a lot of money because of a single event, and that's not something good for the bank, right? Now, how do we capture this risk? And that's a very difficult thing to do. As I mentioned, that there is hardly any data. Bank should have already collected data for a very long time. Regulators were also not worried about climate risk for a very long time, but more recently this is in discussions, and we haven't really put in effort to actually capture good quality data. So there is hardly any good quality data on climate risk at the moment. But good thing is that some part of the climate risk can be captured in other risk areas such as credit risk and liquidity risk and market risk. And these risk areas are well known. We have knowledge about these areas because banks have been dealing with these risk areas or risk types for a very long time. However, the current frameworks, the risk frameworks for these types of risk do not take into account the impact of climate risk. Okay, and the biggest difference between climate risk and all these risk types, credit, liquidity, market, and operational, and so on and so forth, is that climate risk is very forward looking. Okay, and it's very important to understand what it means by forward looking. Forward looking means that something will happen in the future and we need to predict that. You might ask, well, even in credit risk, we are forward looking, we need to think about the future and what will happen. But most of these future events in credit risk are already there in the past also. We have data for them, so we know the pattern, right? You will not very rarely have a completely different default for a bank. Most of the types of defaults the banks are already aware of. So you have the data. Similarly, for market risk, you have tons of data, so you actually know the pattern in the data, historical data. Whereas in climate risk, you could be very surprised to know some of the things that will happen in the future have never happened in the past. For example, the rise in the temperature in recent times in many Asian countries was never experienced in the past. Like significant rise in the temperature, like significant rise in the last couple of years, something which had never been experienced in the past. So it's new, and hence it's difficult to actually model. And lack of reliable data, as I mentioned, is perhaps the biggest challenge. Now, as you know that for banks, what is important to have is to have sufficient capital buffer in case something wrong happens. Then bank should be able to survive. So it should not go into insolvency in case there are defaults, in case it incurs losses. It should be able to return the money that is taken from the people, right, the depositors. And we need to think about what can be done to take into account extra capital buffer for climate risk, right? Do we need more capital to account for climate risk specifically, right? We obviously take capital for trade risk, for operational risk, for market risk, and so on and so forth. But do we also need to take capital? Do we also have capital for climate risk? That's something, a very good question. Obviously, there is correlation, right? Climate risk is somewhat correlated sometimes to other risks, for example, credit risk. To what extent that can be separated is also a big question. Now, in capital modeling, you have this advanced IRB techniques, you have standardized approach. The standardized approach, as you know, is regulatory driven. Regulators have given you estimates, the weights to calculate regulatory capital, whereas in advanced IRB, the banks have got more flexibility and they indeed can incorporate changes because they build their own models, right, instead of relying on the fixed estimates given by the regulators. Since banks have got this flexibility of building their own model, they can indeed incorporate some of the climate risk factors into credit modeling or market risk modeling. Right. So in advanced IRB, that's definitely possible. The problem, however, is that it will be even more complex. The advanced IRB models are already so complex that banks are struggling. Now, if you ask banks to give importance to climate risk and take into account the climate risk factors in credit risk modeling, that will be a big challenge. Some banks have already started doing that, but regulators are not putting a lot of pressure on the banks because even regulators think that it is a very difficult thing to do and it will have further delays in advanced IRB model building process, and it will also have significant impact on banks resources and revenue and cost and all that stuff. And it goes without saying, and I mentioned this, that data gaps. We also do not have data to use them in credit modeling. That's another big challenge. And we also discussed about how it is different from credit risk. So it's future looking, but most of the models, advanced IRB models, are more through the cycle. Okay, that means we want to know on an average what will be the risk for the next 1 year, and we like to know the on average capital requirement for the next 12 months. We are not worried about beyond that, right? Whereas climate risk is so forward looking that even for an event that could happen maybe 5 years down the line, you could still have to take that into account and use that in your model, and that could also have an impact on the capital level. These are open questions. Nobody knows actually how to properly deal with these questions, properly tackle these questions. It's still a debate among people within banks internally, and it's a field that is still evolving. And some people also believe that modeling methodology used in advanced IRB are also not very suitable. That is also a problem. For example, the regression methodology used in advanced IRB modeling, whether it's linear regression or logistic regression, these techniques may not be very suitable for climate risk model development, where you are thinking a bit long term, where the uncertainties are more. Then you have the data is scarce, there's not a lot of data. Taking all these things into account, it is likely that modeling methodology used in advanced IRB model development currently are or may not be very suitable. So how do we address these challenges, and what regulators think about these challenges? Well, regulators think that in long term we definitely have to update the current regulatory frameworks. So we have regulatory frameworks from regulators on different risk types, credit, market, or LM. These regulatory framework need to be updated to take into account the climate risk impact. However, it is a very time taking thing, and even if the regulators are able to update on time, for banks to implement, that will be a nightmare expectations for. That will be an absolute challenge, a big challenge. So what regulators suggest is that on short term and medium term basis, what banks should do is that they should report some of the numbers instead of building models or updating the models to take into account climate risks. What the banks need to do is that to separately assess climate risks and the impact of climate risk on banks' balance sheet. Don't have to build models, but you need to disclose some of the numbers. For example, concentration of assets on banks' balance sheet, which are related to sectors prone to high impact because of climate risk, food and agri, for example, right? And then also assess green green asset ratio. So what percentage of your asset is allocated to green areas? We call it green asset ratio. Calculate that, right? And banks will have to report these numbers to regulator just to understand whether there is significant asset concentration on some of these areas which are prone to high impact because of changes in climate, and that is a bad thing, right? And but as we mentioned that it's not just the individual bank, it could also be a threat to the financial stability overall financial stability, right? So it will have an impact on the real economy. It will bring a recession also. Now, climate risk may have an impact not just on the individual bank, but a risk from one bank could spill over to other banks, because in the times that we live in, banks are very interconnected. The exposure could have interconnectedness, and that could pose some risk, because a risk or a significant loss for one bank could have a spillover impact on other banks. And something that we saw during the housing bubble in 2008, the 2008 financial crisis. So what's important to understand here is that the risks are not captured by banks' own risk management. So this spillover risk, because of impact of climate change, is not necessarily observed in banks' numbers. The numbers that, in the previous slide I mentioned about the numbers that the banks have to provide to regulators. So this kind of risk cannot be captured in banks' own risk management numbers, right? And what is needed therefore is that regulators should also propose the macro prudential approach, which means things or approach that does not just take into account one bank but several banks. It is this approach is applied across all banks within a country, okay, or within a union of countries such as European Union in this case. Now we have this capital based macro prudential approach. It's already in place. Now whether that can be extended to take into account the impact of climate risk is something the regulators are still exploring, but the consensus within experts in regulatory firms or regulatory bodies is that it will bring a lot of issues for the banks, and it will be a burden for the banks. So it's best not to implement this right away. We really need to explore this further. We need to wait. So it is a long-term approach, but not an immediate approach to be followed. And as I mentioned, there are other approaches, for example, concentration charges, right? So we ask banks to provide these details like individually, but we could also, or the regulators could also calculate this for the entire economy, right, for the given country. And you have the large exposure limits. That means you have limits on large exposure. For certain types of industry, you could have limits. Beyond that, the banks are not allowed to lend. These are some of the things that regulators are exploring. In fact, they have started talking to banks on these areas, and just to understand the feasibility of these things. We'd like to conclude. So I've got a very brief introduction. Climate risk is still an area which is explored, and it will evolve over time. It's still an initial stage. But one thing for sure is that there's definitely financial risk because of climate change. Nobody can deny that. We've already seen that in many sectors, in many banks. But it's important to also know that beside individual banks, the risk is also for the financial system, for the real economy. So it's not just a given bank will go bankrupt, but it could also bring a recession for a given country, or even for more than one country, or could be even world, the entire world. To account for the climate risk, the long-term solution will be that the current risk management frameworks across different types of risk will need to be updated. However, that's a long-term solution. When that will happen is not very clear, but supervisors are thinking about doing that in the future. May not be in the near future, but for the near future, supervisors want banks to report some certain numbers, and we have already discussed them, what the numbers are. As I mentioned, our understanding is very limited. It's a very new area of risk management. This area will evolve over time. It's an area where nobody is an expert, so to say, and so over time a lot of things will come. So if you want to lead more, you can just go to IMF's website or Federal Reserve's website or ECB's website. You have plenty of stuff over there to read about climate risk and what regulators are thinking about climate risk. And it's a hot area, by the way, in risk management. Lots of opportunities. All the banks are hiring in climate risk area. All the consulting companies are hiring also in climate risk. So it's an area is still in initial stage. So lots of opportunity. Anyway, if you have questions, please feel free to contact me, email me, or you can also ask your question in the comment section. Thank you.